We're increasingly moving towards a digitised world. It's easy to forget that this all needs to be underpinned by adequate infrastructure. Today we're going to discuss just that in this episode of The Pitch. I'm joined by Resolution Capital's Sarah Lau. Sarah, thank you for joining us.
Thanks for having me.
So digitisation is a theme you focus on in the portfolio. Why is this and what's the opportunity set for infrastructure?
So digitisation traditionally has benefited assets such as mobile network towers and fibre, and they will continue to benefit from this because you do need more and more communication as we get more and more data. But another set that we have found will benefit immensely is actually electric utilities. And that's really because of how power hungry AI data centres are. In the latest estimates, which just came out of reporting season, data centre opportunity set is now estimated to be between 50 gigawatts to 80 gigawatts in the US before 2030. Now, to put this in context, that kind of electricity can power, or we think somewhere around 30 million households, if not more. So that is a significant amount of electricity, and it needs a lot of investment. And they really need to start now because, firstly, supply chains are quite congested, but also secondly, there needs to be a significant amount of planning in order to get these power for these data centers. So what this means is that this is an additional pillar for electric utilities, which are already benefiting from decarbonisation and electrification. So electric utilities, we think the only real constraint in their growth is affordability by customers, which is something that they can manage in the US because a lot of electric utilities own the entire, value chain from generation to transmission to retail as well. So this means that they're monopolies and they're able to design the tariffs such that they can try to maintain affordability for customers. And if usage increases at the same time, which we're seeing increasingly, it means that the bill is spread over a larger customer set and it will be more affordable for them. So we think that this is really an underappreciated opportunity.
Why should investors be thinking about infrastructure for exposure rather than the normal equity names that you might think of?
So investors are increasingly appreciating real assets more and more, and that's because they're inflation hedged. They're relatively resilient to economic cycles, and they benefit from these themes such as digitisation. We're not investing in technology risk, and we're not investing in manufacturing risk. What we're investing in to take advantage of these themes are really monopolies providing critical services. So what we have seen through a couple of technology cycles is that they all, in some shape or form, whether it's a cloud or AI, which is what's driving investment the most these days, they need electricity and they need communications. So what we're seeing here is that regardless of what the ultimate end use of that digitisation is, we need to be investing more in infrastructure. And we think that this is a really competitive but low-risk way of accessing the digitisation theme for investors.
It can be difficult to value companies when you're trying to plan for new cash flows from your tech like this. How do you manage that challenge?
We have a very disciplined valuation approach. We only invest in newer tech when they can demonstrate that there is a high barrier to entry and also resilient cash flows. Thus far to date, we've only invested in these newer tech assets when they're part of a regulated utility framework. For instance, there are some utilities that are investing in electric vehicle chargers that we're very comfortable with because that is a regulated framework. It provides resilient cash flows. But outside of that, we haven't really seen the development of too many of these models come to the sort of high quality investment business model that we would really gravitate towards.
Can you share some examples of some investments you've made for exposure to digitisation?
So we've made investments in US electric utilities that are exposed to digitisation. Two of the names that we really like in particular are Dominion Energy and also Southern Company. So Dominion Energy, its key service area is in Virginia, which includes this little part in Northern Virginia, which houses data centres where 70% of the world's internet traffic actually goes through. Southern Company, very similar kind of themes. We think that Atlanta in Georgia, which is part of their service territory, is emerging as the data center alley of the south of the US. So to put it into a bit of context before my next bit, electricity demand in the US has been basically flat for decades now because population growth has been offset by efficiency. These two names in the key service territories are actually seeing electricity demand growth at close to 9% towards the end of this decade. So in order to service that, there is a significant acceleration in investment, and because the monopolies, they're allowed to earn a fair return on these investments. They're both guiding to 6 to 8% in terms of EPS growth, but we think that this could accelerate and they may be able to deliver on top of this. Dominion Energy is trading on 17 times PE, Southern Company is trading on 20 times PE next year's earnings. But we think that these valuations just of 1 year PE don't really take into account the really long, pipeline of growth that these companies will have, which will extend for decades.
Thank you for sharing your insights on this today.
Thank you, Sarah.
If you've enjoyed watching this interview, please subscribe to Livewire Markets. Thank you for watching.